Welcome to the HRQ Quarterly Economic Insight Series. I'm Sal Vergara, Vice President, Strategic Partnerships at HRQ and Landrum HR. These quarterly economic webinars were developed to help companies not only make sense of the often conflicting data in today's market, but also gain valuable perspective that can help organizations build resilience and take advantage of emerging opportunities. You just saw the scope of what HRQ and Landrum HR delivers to our client partners every day. So please let us know if we can be an extension of your HR team to support any of your human capital initiatives. A recording of this webinar will be sent to everyone who registered. Please feel free to ask questions using the questions pane in the control panel. There'll be a quick survey that pops up as you exit the webinar today, and we'd certainly appreciate your feedback. It's my pleasure to introduce to you Brian Wilkerson. Brian is the head of HRQ's consulting service lines and is a frequent nationally invited speaker and is regularly sought by the press for his thoughtful insight. Brian is known as an innovative strategist and has applied his cutting-edge planning techniques around the globe, where he has become known for helping companies gain an edge through counterintuitive strategies. He's authored a number of articles and book chapters in his areas of expertise and has held senior leadership roles in both large enterprises and global consulting firms, and is a successful entrepreneur who has founded and sold multiple companies. Without further delay, Brian, I'll turn it over to you, sir.
Thanks, Alan. I appreciate everyone attending this webinar. Certainly a lot of news out there and a lot of things to get through. There's a lot of information that's been coming out recently from an economic perspective. I'm going to try to sort through as much of it as I can. There's going to be a few places where I spend more time to try to explain some data that has shifted pretty rapidly over recent months. So I'll start off. Hold on 1 second. All right, there we go. So I will start off as I always do with talking about real GDP. So we looked initially, so the final numbers that we were looking at were the Q4 2021 numbers versus Q3 and prior to that. So the good news that I would have told you if we were just looking at Q4 of 2021 is that we had an increase of 6.9% from the third quarter of 2021. From a real GDP growth perspective, that's actually a higher growth percentage than we were seeing prior to the pandemic. So we were seeing economic expansion in Q4 of 2021, seeing some good trends, about 19.8 trillion overall from a GDP number. That was being driven by increased consumer spending, certainly a big piece of the puzzle always from a US economy perspective. Total government spending had actually fallen back, and we were seeing net exports start to decrease as well. Well, then we got the numbers, or the preliminary numbers, I should say, for Q1. The advanced estimate for Q1 of 2022 actually shows a contraction of 1.4%. While these are preliminary numbers, it's still very concerning when you look at it. As you dive deeper into some of the initial estimates, there were decreases in private inventory investment, and we saw an increase in imports. So, we really started to see us go back to importing more and starting to buy more inputted goods. We started to see some reduction in the amount that companies were spending on inventories. Federal government spending and state and local government spending were reduced in that time frame. We did continue to see an increase in some personal consumption expenditures in what they call non-residential fixed investment and residential fixed investment, which is more really around housing. And people have heard, I'm sure, a lot about housing and that market and where it's been. While we see some cooling off in some places, there's still a lot of markets that are superheated and are driving a lot from a spending perspective. So the background to all of this is that many of the programs that were in place to support the economy during the pandemic have either disappeared or are tapering off, and so a lot of that stimulus is no longer there in terms of that. As everybody's I'm sure have heard in the news and seen in things like your 401k, there have been some turmoil in the market. There have been interest rate increases. The market hasn't really been responding very well to the news from an economic perspective, and so from a very personal perspective, I think a lot of folks are starting to wonder, where are we and where are we heading with this? I will try to predict as much much as I can in terms of that, but I think that we are seeing some dynamics that haven't been seen for a very long time. And that's part of the reason why you're getting conflicting information about where are we exactly. I think that people who are tending to look at what we're seeing as short-term cycle and where we are in the short-term cycle are probably not going to get it right in terms of where we're heading. I think people who are looking over the longer term and looking at, a 20, 30-year cycle from an economic perspective and basing it more on those trends are probably more accurate in terms of where we're heading. So not to get too economist on it, but that's some of the concerns that I see as we look out there. Looking at the sectors from a GDP perspective, again, if you look at Q3 to Q4, we actually had some good news in that a number of sectors, industrial sectors, went from GDP contraction to GDP growth. When you look at that, we really only had 3 sectors that were on the negative side in Q4: construction, utilities, and federal government. And those had sort of reduced the losses that they had, so to speak. The losses got smaller. So good news in terms of that. We don't really have the detailed information behind this to the level that we're comfortable to look at in Q1. But as I mentioned, some of the sectors that were challenging were some of the consumer growth kinds of things. And so we'll see which sectors get hit the most. But a lot of the growth that we saw was in some of the places that we've been seeing growth, professional and technical services, information, some of those pieces. We didn't see as significant of an increase in some of the areas like arts and entertainment and recreation, accommodation and food services, where we had been seeing, significant growth before. So if you look, for example, on the left-hand chart, accommodation and food services were one of the highest GDP growth areas, among the top 5 in Q3, and it was near the bottom in terms of GDP growth areas when you look at Q4. So we're starting to see some slowdown in sectors that were driving some of the economic recovery, and some improvement in other sectors that perhaps have some longer term sustainability, like durable goods manufacturing, non-durable goods manufacturing, and some of those. So some positive signs that we had seen in Q4. We'll see where some of these end up in terms of the Q1 data and how that ties into the overall economic contraction from a GDP perspective. Lots of people ask, are we headed for a recession? As you probably remember from past webinars, the definition essentially is 2 quarters of economic contraction. And so we may be. I think a lot of it will come down to the actions that people take, policymakers and others take over the course of Q2 and where we end up in terms of that. I think some of the things that we're seeing from a pandemic perspective overseas, in China especially, with some of the shutdowns and things of that nature, are concerning in terms of where we may end up from a supply, et cetera, perspective. So I think a lot of reasons to be cautious and to look and really try to understand some of these dynamics at a deeper level and watch them pretty closely. From a labor force perspective, we saw an increase in Q1 in the labor force that was actually greater than all of 2021 combined. So the civilian labor force overall grew by 2.1 million in the first quarter. Certainly that's good news. When you look at that, the civilian labor force is now kind of back to what we would look at as pre-pandemic levels, and actually matching up to the highs from a pre-pandemic perspective. When you look at some of the labor force participation rates going all the way back from March of 2020 to March of 2022, you're still seeing a little bit of we're still below where we were back in March of 2020, but by small percentages in terms of that. And we're starting to see the participation levels for men and women start to rebound more to pre-pandemic levels. So that's good in terms of seeing some positive movement on the labor force front, and some of the factors that were perhaps keeping people out of the labor force are starting to improve as you start to look at it. Unemployment rates relatively stable in terms of where we are. In the April data that we saw a couple weeks ago now, or last Friday, I guess, the economic data from an unemployment perspective is holding pretty steady. So that is not to say that we don't have other challenges in terms of people acquiring talent and things of that nature, and we'll certainly talk about that as we go through. By gender, when you look at it, we started to see a bit of an increase in terms of male participation in the labor force, the civilian labor force, and then we're still below some of the pre-pandemic levels in terms of women's participation in the labor force. So continuing to be a concerning trend in that. I know we've talked about that a number of times in the past. I think that we're, and I'll talk about this more later, we're seeing a lot of reconsideration of people's choices from a work perspective and what they're doing, the kinds of jobs that they're taking, and all those other kinds of things. And I think it's something that organizations really need to be aware of in terms of, even some of the choices that folks are making about staying out of the workforce and really looking for the right opportunities before they re-enter the workforce, et cetera, are an important driver to continue to look at. When we look at people leaving jobs and why they leave their job, the percentage of people who are leaving because they're quitting has actually started to steady. Good news, except that it's at a higher rate than it's generally been. So the percentage of quits is still high when you look at it. It doesn't seem to be increasing over the time period that we've looked at. You can see that line is kind of flattened as we go as that. So it's too early to say how much this is kind of a long-term trend and what implications it's going to have for the, what's been a very hot labor market and those kinds of things, and some of the more, specific concerns that a lot of organizations have in terms of that. But seeing that data start to level out is actually good. I don't think that the quote unquote great resignation is over by any stretch of the imagination, but we are hopefully at least getting to a little bit of a new normal in terms of what that looks like. When you look at some of the data in the other categories in terms of layoffs and discharges and those kinds of things, we're not seeing significant increases in those, so that's good. As we look at that, we'll see in Q1 as we get more of that data, and as we start to, or I'm sorry, in Q2 as we start to get more of that data, as we see, the trail off from Q1, do we start to see more increases in things like layoffs, et cetera. So, but for now, the news is pretty good in terms of that. From an unemployment duration perspective, I think the positive way to look at this is that as people are losing their jobs, they're collecting unemployment insurance for a shorter period of time as you look at the data. So staying unemployed for less time than we saw during some of the pandemic times. If you look at the numbers in the bars in terms of some of the height of the pandemic, October, November of 2020 and into early 2021, that dark blue bar of 27 weeks and over, was high, and it was high as a percentage of people collecting unemployment and things of that nature. So we are seeing some improvement in terms of that. And really that decline in the number of unemployed that started kind of back in June 2021 has continued to reduce, and that's a positive trend. We're also seeing, which is always something that I get concerned about, the number of discouraged workers, declining in that. So people who would like to work full time but can't find full time work, things of that nature, we're starting to see those numbers decline as well. That's always one of the sort of underlying components that I like to look at, because sometimes you can get the wrong impression from the unemployment data because it shows people that it doesn't count the underemployed unless you're looking at the U6 number. So seeing declines in both of those numbers continues to be a good thing. So from an overall employment situation, from an employee perspective and opportunity standpoint, still lots of opportunities out there. From an employer perspective, we are seeing more people come back into the workforce, which is positive from a supply perspective. Quits in terms of just growth rate are starting to level off. And so I think some good news from an overall employment perspective. And I'll talk about the implications for organizations more towards the end, as I always do. Moving on to more of the household pulse survey results. So we talk about this at each of the webinars, and what we're trying to look at is some of the other numbers that give a more full picture in terms of what people may be experiencing or what they're going through in terms of the job market and some of the family life, et cetera. So when you look at food scarcity, we are seeing a creep in that. So numbers really are, most recent numbers are 10.3% of households that didn't have enough to eat in the past 7 days. It had been holding for a while around 9%, still too high, but seeing that number creep up has definitely been, we're concerning about that. The households that are not current on rent or mortgages has been holding at about 6% for the past year. As we start to see that, that is in spite of the fact that a number of states or other jurisdictions have ended protections around rent or mortgage forbearance or things of that nature. And so it's good to see that number holding, but of course, 6% is higher than we'd like to see. From a daycare options perspective, we're still seeing, a relatively high number of households where children were unable to attend daycare at about 28%. So, some of these things are, people are saying, oh, well, people are working less on site and things of that nature. And so maybe that's accommodating for it. But what we're seeing more is pandemic related closures, outbreaks or, different, there's a number of different factors that go into that unavailability of daycare, but continues to be a concerning issue. The adults in households where someone has worked on site in the past 7 days is about 59.4%. It's been in that sort of 58-59% range since about October of last year. So there is a tension around this that we're starting to see in organizations, and some of these things have hit the news. So depending on where you are in the country, some organizations have tried to move back to a more full-time on-site or more time on-site kind of thing. And frankly, they've met resistance in many cases from a lot of workers, especially those who have tried to go back to a full-time on-site kind of arrangement. In some other parts of the country where there's different sets of restrictions or concerns, a lot of employers have actually delayed their what they would call full reopening because of concerns about rebounds in pandemic cases or things of that nature. And so a lot of mixed strategies in terms of what people are doing for their return to work or return to full on site or things of that nature. Interestingly enough, there's some research that came out in March that talked about the workers that can do their work from home, how much of they are they staying home. And interestingly enough, the number is pretty similar in terms of the percentage that are staying home and doing their work from home is about 59%. So it's kind of an interesting set of data, and I think a lot of this is going to play out over the next several months in terms of what is the new normal, but I don't think we've found it yet. If I look at these pieces, there's all kinds of local data or polling data or those kinds of things that say what are people going to do or what are they planning on doing, et cetera. But we'll see how these numbers play out. I think this is, and I'll talk about this more a little bit later, but this is a really important piece for organizations to work through right now in terms of what are their strategies, what are their expectations, and how is that going to work? The one thing I can tell you for certain is that the expectations on the part of employees about what they should be required to do has definitely changed. So that is something that we hear over and over again. And so organizations thinking through what their strategies are going to be and how they're going to address that is critical. There are obviously a lot of different variables in that mix. Lots of clients that we work with have work that essentially has to be done on site, right? Anything from utility workers and police officers and things of that nature to, work that really has to be performed in person. And a lot of these organizations who have a mixed workforce, some who can do work in person and some who can do work remotely, are struggling with what's fair, what's equitable, how do we actually look at policies around who can work at home and who can't, and things of that nature. So a lot of energy and attention in this area right now. I wouldn't say that I've seen so far, organizations that have absolutely got that locked in and have the model right just yet, but a lot of experimentation in terms of what does make sense and what's the new normal going to be. From an overall jobs perspective, total non-farm employment, we've essentially seen 2 years of consistent job growth since about May of 2020, but we're still not quite at the levels that we were pre-pandemic in terms of the number of overall jobs available. When you look at sort of February of 2020 to April of 2022, we're still about 1.2 million jobs below that kind of height as we look at it. So the March and April of 2020, we lost about 22.3 million. Probably a lot of people have that number memorized at this point because it was a huge number that we lost. We've increased from sort of May to December of 12.3 million, and then January of 2021 to April of 22, about 8.8 million jobs that we've gained back. So the net is we're still about 1.2 million jobs below pre-pandemic levels, but we're continuing to see good trends in terms of job growth. When you look at the job gains in the first quarter of 2022, 1.68 million total non-farm jobs. So, positive in a lot of different sectors. From a goods producing standpoint, construction and manufacturing, we're driving that. Particularly good to see that growth in manufacturing, again, seen as a little bit more long-term and stable in that respect. Still a lot of growth in the services sector. Services continues to be a huge driver. Some of these areas like professional and business services and some of those kinds of things continue to be big drivers of this. Leisure and hospitality was about 404,000 of that 1.46 million. So even though the overall growth from a GDP perspective has slowed down somewhat, it continues to be creating jobs from some of those different perspectives. So, but some good diverse industries in terms of services growth. Government from an employment gain was primarily on the local side, not as much on the federal or state side. Job openings, which is obviously another one that we watch closely, is been relatively steady, but that number is still at historic highs. We're at about 11 million in terms of the job openings that are out there. That's 3.7 million more than we had in February of 2021. So when you look at it, we have seen really a historical trend in terms of job openings that are out there. So unemployment numbers stabilizing and some of those kinds of things, we're not really consuming these openings as fast as a lot of employers would like. And I'll talk about implications for that in a second. But I think we're continuing to see what I would call a tight labor market, or more of a seller's market from an employee perspective. More opportunities that are out there than really workers who are willing to take them. So that's an important piece of the puzzle. I think that a lot of organizations have tried to address some of these issues in a very traditional way. When I say very traditional way, that means throwing money at it, increasing starting salaries and things of that nature. That does have some, short-term positive impacts in terms of acquiring workers. But what's different in terms of what we're seeing in this recovery is the change in desires, expectations, and what people are willing to do. So people are less willing to take jobs that don't fit, their vision of what they want to do and what they want to be. The, jobs that people find less desirable are having a big struggle in terms of really getting people to take those jobs. And so throwing money at those particular ones is having a minimal effect in terms of that. For organizations, really looking at the desirability of your industry, your company's reputation, all of those different kinds of things is a really important component of trying to get the talent that you need. And just being able to, pay more or throw money like that is not going to have the same impacts that it had in the past. So when I look at this, and I'll talk more about it, the organizations really need to think about their strategies from an attraction and retention perspective. what it means in the short term is you're going to continue to see people with lots of opportunities. You're going to continue to see turnover increase in organizations. And money will be part of that, but it will be just as much about people finding jobs that align with what they want out of work and what they want out of their work life. It's even interesting to me to, see some of the commercials that you're starting to see on, not see or hear on, satellite radio and things like that, in terms of more workforce worker friendly kinds of solutions being advertised, and the popularity of those kinds of platforms is increasing. So when you look at, if I were to summarize, really from an employment perspective, I would say this: we're continuing to see more people come into the labor force, but we're not matching up to the opportunities that are out there. The labor market continues to be tight, and it's important for organizations to really think about how they're going to respond to that. So thinking about brand and value proposition is really going to be a key component, as well as making sure that you're seeing, that you're keeping your salaries on par. What I hear over and over again from the clients that I talk to in senior leadership roles is they continue to be surprised by the amount of money, for example, that people are getting as increases when they move jobs. I don't know why, but yeah, because the market certainly implicates that. But I think it's important for organizations, as you're evaluating your turnover, to not just think about, well, what kind of salary increases are people getting, and understanding beyond that, why are people leaving and what are some of the dynamics there, and are there things that you can address from a brand or employee value proposition perspective, in order to really make yourself more competitive, more attractive. From a self-employed perspective, I didn't hit this, but we're continuing to see sort of similar trends that we've seen, where it continues to hover in the same basic neighborhood in terms of self-employment. So not a lot of news there. From a small business perspective, in looking at these charts, we were seeing some leveling off in terms. I'm going to start with the right-hand chart first. We're starting to see some leveling off in terms of supplier delays. Now we're starting to see some increases or some ticking up of those numbers again, which is obviously concerning. As you look in the, number of increases and number of decreases in terms of the paid employees, we're continuing to see the number of employees who increase their number of paid employees growing faster than the ones who are declining. So again, a good trend in terms of some of that, but these are focused on small businesses specifically, and some of the things that they're challenging, or the challenges that they're experiencing, which are obviously a big piece of the economy. So some numbers to look at, when you look at the sort of annual percent change in hourly earnings, and compare that to the consumer price index, this is where we start to see the rub, right? When you look at essentially the annual percent change in hourly earnings has been about 5.5%, but the consumer price index has been about 8.5%. The numbers that we're seeing in terms of increases in salary are actually historically high, but we're really not keeping up with inflation still. Sadly, that's been a trend that we've been on since the 1970s. So we still have a problem in terms of wages not keeping up with the cost of living, and it's even more pronounced as we look at historically high and inflation and some of those things. Consumer confidence is still relatively high in terms of being at 107.2%, not as high as we have been. Some of the factors that are pointing to waning consumer confidence is things like rising prices at the pump, war in Ukraine, and things like that. And when you measure purchasing intent for larger scale items like automobiles, those are starting to wane in terms of looking at leading indicators, as you start to look at, interest rates rising and things of that nature. So there are quite a few things that need to be paid attention to as you look at that, because some of the sentiment from a consumer spending perspective, which is obviously a big driver of the economy, is showing some concerning signs. So we want to make sure that we continue to watch that, and as interest rates rise, we expect that that's going to continue to happen. the risk, of course, is that that exacerbates some of the small declines that we've already started to see from a GDP perspective and starts to make things worse. So we don't want to get into a cycle where we start to see, any sort of spiral into a deeper or longer term recession. If you look at inflation across categories, you can kind of see the past 12 months, which is the green line, versus the first quarter of 2022 and what we're seeing in terms of that. When you look, the only place where we're seeing a decline in these increasing inflation trends is in used cars and trucks. Everything else, we continue to see sort of increases from an inflation perspective, as we've been seeing for quite a while in all of these categories. So when you look at the way to look at this chart is that the green line is for a whole year and the darker line below it is just for one quarter. And so if you're starting to see the darker line be a bigger percentage of that overall green line, what it tells you is that inflation is rising fairly fast in those categories relative to even what it's been in the past. So a number of these categories, we see basically a continuing kind of trend. So if you look at all items versus food, for example, the overall inflation versus the quarterly trend kind of match up. If you look at energy commodities, and overall inflation has been bad enough, but if you look at the first quarter rise in inflation, that's certainly very concerning. So where we end up with a lot of these things from an employee perspective is wages that aren't really keeping up from an inflation perspective, and a perception that I'm not getting as far on my salary, or I'm not getting as far on what I make as I used to, right? Whether it's in some of these high cost areas. I can't go anywhere now without people talking about, it used to cost me this much to fill up my car and now it costs me this much, or it used to cost me this much to get my weekly or bi-weekly groceries and now it costs me this much. This is a topic of conversation literally everywhere. And as people start to look at their household spending, things of that nature, they're obviously going to look at their salaries and those kinds of things. So to the dynamic that I talked about earlier, if people see an opportunity to go someplace else, get a significant increase in salary. In the past, we used to say if you had really engaged employees, it would take more for them in terms of an increase in salary for them to leave you and to go someplace else. And that's still true. But what I would say is that in times like this, when people feel like their spending power is declining and things of that nature, then they're more apt to listen to those offers if the increase is significant. And in a lot of cases, we are seeing that those increases are significant in terms of what people are being offered to potentially go somewhere else. So my big thing is that, as I've always said, money isn't everything, but it's a really important thing right now when you start to see numbers like this. So getting your compensation approaches correct is certainly very critical. When you start to look at some of the leading indicators that we're seeing, from a commercial construction perspective, we're seeing about an 18% increase from where we were a year ago. On the flip side, the single family homes, the sold are down about 6% from a year ago. It'll be very interesting to see what happens as mortgage rates continue to climb. Some of the predicted increases in interest rates in the June and July Fed meetings are certainly a big question marks in my mind in terms of what impact that they're going to have. In addition, these interest rates hikes at some point, sometimes before, sometimes after, tend to have a hit on the market. And if people see housing prices up, mortgage rates up, their 401k or their stock portfolio declining, and all of these kinds of things, and inflation continuing to rise, it tends to lead to significant cutbacks from a consumer spending perspective. That tends to exaggerate or exacerbate, these whole recession concerns and the decline in the overall GDP, et cetera. So it becomes a self-reinforcing cycle. So it's going to be really important for policymakers to get this right, or else we could really fall into a period of prolonged recession or decline, or some of those things. And especially if we continue to see, supply challenges, et cetera. I could certainly envision a scenario that would be very unpleasant from a standpoint of a lot of things converging together. And so I think as from a company perspective, it's really important to think about your future investment strategy and have more of a scenario-based strategy. What if the economy goes this way? What if it goes this way? And what are our reactions going to be? To get back to leading indicators, durable goods, new orders, generally speaking, continue to be on an upward trend. We did see a little bit of a dip in some of the most recent numbers. Basically, we're continuing to see good applications for new businesses, and we're seeing about a third of those businesses essentially what they call a high propensity to eventually pay wages or have employees. As you look at new businesses, being at about a third of those. So that number has stayed relatively steady. This trend has been fairly flatlined over the past several months as we look at it. And so we're not seeing, dramatic increases in new businesses. That's kind of holding steady. So the data is okay. Nothing for me to be overly encouraged about or overly discouraged about as you look at some of those pieces. More good news on the COVID front. Basically we're 95.6% of the counties have a low, community level of COVID-19. We have seen some spikes in certain areas around the country, and in some cases, some reimposition of restrictions and things of that nature as you look at it. But generally speaking, we're seeing good trends from a COVID perspective. One of the most positive trends, is the number of hospital admissions and inpatient hospital beds being used by COVID patients. Right now we're at basically less than 10 new COVID hospital admissions for 100,000 people, which is, much lower than it had been. And we're seeing essentially less than 10% of the inpatient hospital beds in use by COVID patients. So both of those are very positive in terms of that. I know that there's been a number of warnings that we could see a surge in the fall and things of that nature, and that all certainly could happen. But I think in terms of where we are now, and hopefully sort of staving off, potentially economic downturn, if we can keep, people out and keep consumer spending up and activity at that level, then that's going to help us, avoid a deeper or more prolonged kind of recession. So good news, I think, from an overall COVID perspective. So of course the question becomes then, what should you be thinking about now from a company perspective? And the two themes that I really want to emphasize is thinking about your workplace and your relationship with your employees, and then thinking about the way that you get things done. These are the two sort of fundamental questions that I think organizations need to be asking themselves. When I look at the data, I think there are a lot of things that give me some pause and say we could be heading for a time when organizations need to rethink their strategy around, employment and labor and supply chain and a lot of those kinds of things. So I think we're in a lot of industries, we're already there. But if we start to see continued decline from an economic perspective, continued inflation the way it's been, et cetera, it's going to be a shock to the system for a lot of employers. And so I think there's a number of things that organizations need to be thinking about. First, I think it's very important for organizations to be able to get ahead of these different trends. So, all of you who attend this webinar regularly, it's great because, you're trying to stay on top of these things and see where the stuff is going and what its implications are. It's really important that you can, at a more micro level, understand how some of this data directly translates into the implications for your company. And even more important, get ahead of that from a predictive perspective. What we're seeing in companies who I really think are preparing well for, and have prepared well for where we've been and where we're going, is they're really trying to get ahead of things. They're trying to look further into the future and really understand, as unemployment changes, or as durable goods orders changes, or whatever it is that really drives your industry, what are the implications for us in terms of labor supply, labor cost, turnover within our organization, and metrics such as that. So, and how does that tie into overall supply issues? So for example, China has now, in certain cities, been in lockdown for, in some cases, a couple of months, right? Well, we haven't yet begun to feel the impact of some of those shutdowns from a supply chain perspective. And so as those start to hit in a couple of months, what are the implications going to be for our business, for our labor force, and those kinds of things? Having the right analytics in place to be able to predict those impacts, have plans and scenarios in place for how you're going to address them, is going to become even more critical than it ever has been. The one thing I can predict fairly confidently is that we're in for a bumpy ride. I don't think the rest of the year is going to be continued upticks. I think we're going to go through a number of bumps caused by a lot of the different dynamics that I've been talking about. So I think it's really important for organizations to get as far ahead of that curve as possible, and having the right predictive analytics that match up to your industry and your organization is a critical foundation for that. Second is really around retention strategies. I mentioned earlier, we're seeing a lot of places where employees are leaving for significantly higher pay, and other cases, significant promotions, and a different lifestyle in a lot of cases, or a different industry, or different choices about what they want their career to look like. It's important as an organization to take a very fundamental look at your retention strategies and where you are. To do that, you've really got to look at a number of different factors. First and foremost, you've got to look at your employment brand and your employment value proposition. What is it that you're sort of giving to people? Why work for you versus work for someone else? Think about, as you look at those factors, what is it that really differentiates you in terms of a good place to work? Or if you have some weaknesses in that respect, how are you going to address them? That's first and foremost, because that is a very prominent factor that will keep people from looking in some cases, or help them sort of resist those calls that they might be getting in terms of other employment offers. So first and foremost, brand and employment value proposition. Second, looking at compensation and making sure that you have that right. And I'll talk a little bit more about that in a second, but making sure that you're in the right place from a market perspective. I never have and never will, look at compensation as a substitute for getting other parts of the work environment right. But it's more important than ever to really have that parity and be on par from an overall compensation perspective. So that's a second factor in terms of that. The third is really looking at your work environment in terms of your managers, your culture, all the different things that make you a better or worse place to work, and being very honest with yourself in terms of where you are around that. From a retention perspective strategy, I have never, people have heard me talk about this before, but it's really important to not just throw money at the problem, but to engage in deeper conversations with the employees that you want to retain about what's going to keep them there and what's not. So those are the kinds of conversations that become really important in this. But thinking about those three things, overall employee value proposition and brand, compensation, and then other work environment factors, is really important to developing a targeted retention strategy. Figure out who you want to retain and how you're going to do that. A third piece of the puzzle is really around labor sourcing and labor automation. I've been talking about this, I think, since early last year in terms of especially the labor automation piece. A number of organizations have gone down the path of trying to optimize from a labor automation perspective and move as much of the work that makes sense to a more automated piece. We've seen more advances in AI and things of that nature during the pandemic that's enabled that. But it's really important to get this right. The labor sourcing side of it then says, okay, if I've automated what I can automate and I've reduced my reliance on labor from that perspective, what are the things that I should then do in order to source the appropriate labor from the appropriate places? This starts with a fundamental examination of what should you be doing in-house and with your own employees versus what should someone else be doing. That someone else could be, contingent labor in the terms of contractors, consultants, whatever it is. It could be outsourcing, it could be co-sourcing, it could be crowdsourcing, it could be a number of different strategies. But there has never been a better time, or frankly, more important time, to really look at that labor sourcing strategy. I will unfortunately be a little bit critical of HR at this moment in time, because I think that they are not focusing enough on a blended and diverse labor sourcing strategy. There's so much focus in organizations right now of getting people hired and getting them in the door. And I get it, that's important, right? And we have operations to run and things of that nature. But I think we're heading for more of the typical cycle where we hire, 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 and then as the economy goes down, it's like, oh, fire, fire, fire. And so, which is really not good for organizations. And I've talked about that many times before. But so thoughtfully looking at labor sourcing, understanding the stability of demand, understanding, the dynamics of different positions, et cetera, has really never been more important. This is unfortunately an area that a lot of organizations don't have the in-house talent to be able to actually craft this strategy in a robust way. They don't have the predictive analytics. They don't have the kinds of things that they need to really answer this question in the way that it needs to be answered. So this is the kind of place where looking for third-party help is probably going to be important for most organizations. There are some that have these capabilities, but really finding that partner that can help you figure this piece out is going to be really critical. Supply chain optimization is another piece of the puzzle. Again, one that I've been talking about for a long time. But as you saw in some of the data that we were looking at, we continue to see increases in supply disruptions or supply delays as you look at it. Some of the things like China shutdown aren't even in those numbers yet, as we start to look at some of these things. So supply chain optimization is going to continue to be an important piece of the puzzle. Blended strategies that look at nearshore versus onshore versus offshore, and really understanding how you optimize that mix is again critically important. This is one that I'm hearing this conversation constantly in our clients, and a lot of organizations are trying to do this. And as you look at it, this whole idea of labor sourcing and labor automation, supply chain optimization, all kind of go together, and you could think about it in terms of, the whole supply chain of people and goods, right? And really that's how we tend to look at it is, your supply chain is more than just the materials that flow through your organization, but it's all the things that you need to create whatever you create for customers. So trying to optimize across those different categories is really critical. I talked a little bit about compensation, and I would tie into that career architecture, which sounds kind of boring, but really what we're talking about here is how do you look at both compensation and how you compensate your employees, but also what kind of opportunities do you create for them? One of the biggest things that we've seen in terms of reasons for people really leaving the organization versus what they say on exit surveys is around development opportunities. Most people in organizations, and there's this kind of interesting duality. Many of them will say, yes, there are opportunities in the organization, but their concern is that they don't know how to access them. They don't feel like they have the resources to capitalize on them, and they feel like, they're kind of out of that loop, so to speak. When you really dig in a lot of organizations, there often are a lot of opportunities, but there's not a lot of good communication. There's not a lot of good resources in organizations in terms of that. And frankly, a lot of organizations, especially ones that have been high growth or, have been fast changing, the opportunities have been more organic, for lack of a better term. They just kind of come up as the business evolves and things of that nature. But increasingly, employees, as they cite why they're leaving, an organization, the opportunities piece is a huge one. And not only feeling like they're there, but that they know how to capitalize on them. They know how to identify them, et cetera. When you look at compensation, right, as I've talked about, getting that right, but then those things are linked as well, because people equate advancement not only with, new opportunities and expanded scope, et cetera, but also with compensation. And one of the things that we've heard is like, people concerned that they didn't know how to get to the next level of compensation given, the structure of their organization, et cetera. So understanding and communicating the compensation philosophy and career architecture, what the opportunities are, how you access them, et cetera, very important. We've seen a huge increase in the demand for these kinds of services over the past year, especially both compensation as well as developing more robust, more accessible career architectures for organizations. And so, a lot of good work has gone into that over the past year, but continues to be a high demand service from our perspective. Finally, and by no means the least important, really looking at culture and engagement in your organization. I don't think that most organizations really have even started to scratch the surface in terms of how they have changed because of the pandemic. I was recently with a client who, a lot of people, they had a corporate event, and it was the first time that the company had gotten together in, 2.5 years, basically. When you look at those things and just seeing, just as an outsider, being able to observe those dynamics and seeing how they changed, was really eye-opening to me, in terms of just the interactions among people and all these different pieces, what they talked about and how they talked about them. I think that we're just starting to learn really what the implications of the pandemic have been on culture and on engagement. Couple of things in this area. One, understanding what your culture truly is now, not what it was pre-pandemic. I don't know any organizations where their culture hasn't changed, at least to some degree. So getting a very good handle on what your culture actually is now, and then looking at how you want engagement to look, how you want to define it, how you want to promote it, how you want to create more opportunities for engagement. Because as I mentioned earlier, when you have these modified work schedules and people taking all different kinds of approaches in terms of returning to the office and things of that nature, engagement is different now, and really looking at what that means. I think that what we're seeing a lot of our clients' experiences is that there is an increased level of disengagement, meaning people see themselves more independently from their company as they've been distant from it or working remotely, and some of those things as you look at some of the implications that the pandemic has had. And so I think in a lot of organizations, engagement has to take on a new meaning. What do we really mean by that, and what are our employees' expectations around that, and what are our expectations around that, and all of that then tying back into the culture that you want to have. The decisions that organizations make, over the next few months about how they return to the office, some of the policies that they create, what they do from a culture perspective, et cetera, are going to have very long-term ripple effects on the organization. And in a market where talent is already tight and difficult to get, increasing in costs, all of those kinds of things, getting this right becomes an even more important factor as you start to look at it. So no shortage of things to do. And frankly, I think a lot of these are very fundamental questions that organizations have to ask themselves and figure out how they're going to address. Certainly from our perspective, we've had a lot of success in terms of helping clients work through some of these issues. Happy to continue to help folks in that respect. But this is kind of the top list of things that really need to be looked at and really need to be addressed from a today's workforce perspective. I think for organizations, my advice is, be very cautious in terms of looking at where you're investing and where you're putting your eggs, so to speak, in terms of investments, given the uncertainty that we're starting to see in the economy, and some of the effects that could happen from all the financial chaos that we're seeing right now. So with that, I will wrap it up and open it up for questions.
Ryan, thank you very much for all that. We do have a few questions from the audience. What resources are available to compare competitive wages by positions?
Well, right now, that's certainly a challenge. And the reason I say that is because for many types of positions and that sort of thing, the sources of information are not moving as fast as the actual data. So there are a number of online resources that are available in terms of making comparisons. My caution is that, one, you need to make sure that the positions that you're looking at are actually apples to apples to what you're trying to compare. I've seen a number of places, for example, where common names of positions like engineer or analyst or those kinds of things, but radically different definitions. So make sure you're using the right categories. And the other thing is, I would look as much at postings that are out there for positions, as I would, rearward facing salary surveys. And I think what you're going to find is that somewhere in the middle is probably where the truth lies. So, in Colorado, for example, we have a law that requires you to post the ranges for salaries, the actual hiring ranges. And so looking at how some of that data compares to the historical data that you would find in salary surveys or some of the online salary services, I think is kind of an important reality check, because like I said, there are certain spaces, certain markets where the data is moving faster than the surveys can keep up.
Got it. Now, you touched upon this next question here in your presentation. The past 2 years have created a new and unique landscape for candidate attraction, talent pipelining, and talent retention, especially within a hybrid remote context. Do you feel that this trend is here to stay, or will it slowly migrate back to pre-COVID standards and norms?
Yeah, I'll probably get myself in trouble with this answer, but I think if you don't rethink how you do things, both from a talent acquisition process perspective, but also from a work and hybrid work policy perspective, um, somewhere in the 5 to 10 year range from now, you won't be able to attract talent anymore. Essentially, what we're seeing is that the desire and the changes in expectations from the employee base is so strong, um, that it really is a driving behavior on that side. If we go into a recession, will that tamp that back a little bit? Sure. But when we rebound, we'll be back to this. I have not, in my 27 years of doing this, seen this kind of embedded, deeply held change in the attitudes and mindsets of employees about what they're willing to accept and not accept from a work perspective. The number of people who are willing to be long-term unemployed in order to find a situation that matches their thoughts about what they want their workplace to be, is like nothing I've ever seen. And so I think for organizations, you have to rethink these pieces. You have to really think about this. And if you don't have some opportunities around hybrid work and those kinds of things where it makes sense, it's going to be increasingly difficult for you to compete.
Agreed. And we're seeing that every day in our searches and interims.
Mm-hmm.
I think we have time for maybe one, maybe two more. So the next one, with inflation still affecting our economy, what should organizations prioritize first to ensure they successfully navigate through these challenging times?
So I think I'll focus more on the employment side of that. There's a lot of implications in terms of overall supply chain and those kinds of things. But from an employment side of it, one of the things that you really have to look at is how well your wages have kept up over time and where you are against inflation. I was looking at some data the other day, and I literally went back like 3 times to make sure that it was correct, because we were seeing essentially that the actual wage increases from 2021 to 2022 were trending towards the 13% or higher space, as opposed to, if you think about what your merit budget was last year, I'm guessing it wasn't 13%, right? And so if you look at some of those things, it's really important to do that analysis and look at it. But it's also important to spend that money in the positions that matter in your organization, those places that really make a difference and that drive your success from that perspective. Because I don't know any organization who can keep up, maybe a couple, but overall there's not a lot of organizations that can fully keep up with the rate at which wages are ascending and some of those kinds of things. So it's got to be strategic, but you've got to do that analysis to really see if you're keeping up from an inflation perspective, because again, all people hear about all day long is inflation. And so they're starting to ask those questions in their head and ask, am I keeping up? And so sooner or later, they're going to ask you.
Right. Words of wisdom from Brian Wilkerson. So, Brian, thank you for the time today and the effort that you and the consulting team put into providing this content. Audience, if you have any questions or if you need any support for your HR initiatives and projects, please reach out to us and we'd be happy to help. On behalf of Brian, HRQ, and Landrum HR, I'm Sal Vergara. Until next time, elevate yourself and those around you.